My name is Garrett Van Nostrand, and I'm a financial advisor with Nostrand Wealth Management. Here's what happened during the first half of 2025. First, let's start with the stock market. The S&P 500 ended the quarter at an all-time high after seeing a 19% drop. A majority of the drop came after the higher-than-expected tariffs announced on April 2nd. The effective tariff rate we now have is about half of what was announced on April 2nd, which has helped calm markets. But the average rate of 15% is still significantly high. So high, in fact, the last time U.S. tariff rates were at 15%, sliced bread was the most viral trend in the country. I'm not kidding. Sliced bread literally went viral in the 30s. When we saw this drop in April, the unprecedented times narrative was being used a lot. But the S&P 500 actually averages a 15% downturn every year. So with that in perspective, a 19% drop and subsequent bounce back is nothing that the market hasn't done many times already. And yes, the method of the drop and bounce back might be unusual, even unprecedented. But we live in a complex and ever-changing world where unprecedented events is kind of the norm. I guess you could say we live in an unprecedented planet where the unprecedented is actually extremely precedented. Despite the large tariffs, the S&P 500 bounced back to an all-time high, and I don't think the quick bounce back should come as much of a surprise. We are, after all, in the midst of the AI revolution. When we look back at extreme inflection points in our history, like the Industrial Revolution, for example, what we see is a massive wave of innovative change. When we look back at the Industrial Revolution, we don't think about the economic policy at that time. The momentum of newly introduced technology was so significant that picturing economic policy decisions halting that wave is like someone trying to stop an actual wave in the ocean. It's not to say that there aren't very real impacts that tariffs are going to have on people and certain companies. It is absolutely going to be a struggle for many companies to adjust to the changing policies. But speaking from the perspective of an investor trying to understand why the broader market continues to go up in the face of tariffs, I think it's because there's an extremely momentous technological revolution happening because of American tech companies. As I mentioned though, tariffs will take a very real toll on some of the companies. Because of this, diversification as an investor is extremely important right now. In fact, diversified portfolios have excelled so far this year. Entering 2025, there was next to nobody expecting European stocks to outperform the US, in large part because the vast majority of AI benefactors are US companies, and Europe seemed to have been stuck in economic quicksand. But the economic picture in Europe is improving, and the Eurozone has returned close to 30% this year for a US investor, while international markets as a whole have returned about 18%, compared to a 6% return for the S&P 500. What has really helped US investors benefit from investing internationally is a drop in the dollar. The dollar has weakened by almost 11% this year. When we, as a US investor, invest in another country and that country's currency strengthens against the dollar, our investment gets both the return we made on the stock and the positive return we got on the foreign currency. So, European stocks would have returned about 13% for a European investor this year, but almost 30% for a US investor thanks to the euro strengthening against the dollar. Tariffs are projected to have a meaningful impact on inflation in the second half of the year. But inflation has actually remained quite low thus far. We saw a 2.3% inflation number in April and 2.4% in May, which is very close to the Fed's target of 2.0% inflation and meaningfully below the 9.1% peak we experienced in June 2022. Companies ramped up imports earlier this year to build up inventory ahead of tariffs, so we haven't really seen the impact in any inflation reports. With inflation as low as it is, we likely would have seen the Federal Reserve cut interest rates, but they have instead chosen to hold rates so far to wait and see how the economy reacts to tariffs. The Fed holds a dual mandate of low inflation and full employment. And much like inflation, employment has held up quite well in 2025. We have an unemployment rate of 4.2%, which is quite low historically, and another reason why the Fed feels it does not need to be in a hurry to cut interest rates. Layoffs are very low in the US, but companies are reluctant to hire and are holding a wait-and-see policy on the economy, much like the Fed is. New college graduates are having a difficult time finding work as a result, and the gap in the unemployment rate between new college graduates and the rest of the population is the widest it's been in the past 35 years. On top of that, home ownership is becoming increasingly difficult for younger generations to enter into. Home prices have soared since the pandemic. For over a decade leading up to the pandemic, the average mortgage rate didn't rise above 5%. And now we're going on almost 3 years that we haven't seen the average rate below 6%. As a result of this tough environment, the median age of a first-time home buyer is now 38 years old. It was 29 back in the 80s. On the flip side, a high cost of borrowing means it pays to save. 5-year treasuries have returned almost 5% this year, investment-grade corporate bonds have returned over 4%, and you could still get 3.5% in an FDIC-insured high-yield savings account. Not to mention, the S&P 500 is up over 95% in the past 5 years. I just want to mention that to point out that I don't think younger generations are doomed from ever owning a home. I think it's very possible that there has been a sleeping giant of potential first-time home buyers taking advantage of these high rates and building up a sizable savings account to use for a future home purchase. That's what's been happening in the economy so far in 2025. If you have any questions or you want to talk with us, go ahead and reach out on our website, vnwealth.com, or you can email me, gvv@vnwealth.com.